What's up, world? Michael EJ here, bringing to you another video in the topics of finance, business, and life. And today, I like to talk to you about investment horizons, time horizons. How long do you plan on holding an investment in the stock market? Now, like I've mentioned to you all before, in order to beat the market, you must think differently than the market. And one of the best ways to think differently than the market is to just think about your time horizon. Use that as your edge. In using your time horizon, you're going to think differently about where your returns come from. And you can use that to your advantage as well. Now, let me just paint a picture to you. Most institutional investors and most value investors, most investors in the stock market in general, they usually invest with a 1 to 2 year time frame. That's usually the time frame they're working under. You look at equity research analysts, they only really project only for 1 year. Most valuations only project 1, 2, maybe 3 years out. If you stretch it out a little bit, some investors look at 3 years, some might go short term in 6 months. So that's usually how most people play it. Mainly 1 to 2 years, but you extend it out. Almost all investors are in a 6 month to 3 year time frame. Now, how can you take advantage of this? Now, first off, you can invest in strategies that are shorter than 6 months. A higher turnover strategy. And some of those work really well, if it's shown to work really well. One is momentum, arguably my favorite strategy. There's actually different academic studies that show that you invest in the top stocks over the past 3 months, 6 months next year, and they're going to outperform over that same time period. One of the best ways, and probably the easier ways to invest. You also have earnings release, earnings momentum. There's a famous study about what's called post-earnings announcement drift. You just wait till earnings come out on a quarterly basis. Look for stocks that beat their earnings projections by the highest amount. And although the initial pop might be like, oh, that's all the stock, that's all the room has to run, they usually drift a little bit higher for the next 1 to 3 months. Very effective strategy that can be used. You can also take more of a catalyst-driven, event-driven strategy. Look at maybe dividend announcements, buyback announcements, maybe corporate actions. Then you can trade off of that in a shorter 6 month time frame. Now, if you're going to invest in this area, remember, market returns come from either fundamentals or market sentiment. In a shorter 6 month time frame, you're paying a lot of attention to the sentiment. What are people's opinions on that stock? I mean, it can fluctuate in a short time frame, but focusing on those type of strategies and taking advantage of increasing sentiment or very high sentiment in a short time frame is very effective. You can also turn it all the way around and plan on holding stocks for longer than 3 years. Now, this is a strategy that is very effective and a lot of investors choose to take, especially retail investors like you and myself. You usually look at this 3 year plus time frame because it's easier, you can understand the companies, there's a lot of different ways you can look at it. So 2 effective strategies that I've found out over time is looking for a company that has long-term changes in supply and demand, long-term structural changes. For example, look at different industries that plan to grow at a very high clip. That's structural change usually on the demand side. You just pick a company that you think is best positioned to take advantage of that long-term demand trend. You can also look at the supply side, consolidation, less competitors. Look at big M&A transactions, maybe more mature industries, easier to predict industries, and understand how the dynamics of the transaction is going to work. They increase their market share, they kind of dominate, and they will probably do pretty well over the next years to come. You can also look at, just pick the most innovative companies and invest in those and stay invested in them for the long haul. That's been the secret behind all those famed stocks. They're just probably the most well-known, innovative companies out there And because of that, they just continue to find ways to compound earnings. Now, if you're going to take longer than the 3-year track, and I suggest this for the shorter period too, but especially for the longer 3-year track, valuation is not going to matter as much. In the short term, valuations are driven by market sentiment. You can take full advantage of that in a short 3-month, 6-month time frame, where sentiment is not going to just dive off a cliff all of a sudden. Usually sentiment lasts for a couple of months, a couple of weeks, couple of months. You can take advantage of that. In over 3+ years, it's really all about the fundamentals. And when I say fundamentals, I'm mainly talking about earnings growth. I mean, you should be looking for companies that you expect double-digit earnings growth over a long time. 3, 5, 7, 10 years. You expect them to just compound that earnings growth. Just keep it growing and growing. That's where this really matters. So some of those companies today might be fairly valued, might be a little bit overvalued. But that's okay, because you're not depending on market sentiment. Valuation shouldn't matter as much. If a company's fairly valued and you think it can grow earnings extensively for a very long time, you should invest and just hold it for a while. Things will work out in your favor. Now, the mistake that people in this 1 to 2 year time frame really make is they want a little bit of both. They try to hedge their bets. They want the fundamentals to be really good, grow at a decent clip, maybe with the economy and with the market, but at the same time, they want market sentiment to swing in their favor. And a lot of them, when the stock price continues to go down, they double down on their bets. They double down on their investments and invest even more, hoping that eventually the market will turn in their favor. Now, sometimes it does. A lot of times it does. But sometimes it does not. And I'd rather not take the risk. I'd rather say straight up, I'd rather just invest in a company knowing that the market sentiment is very high, will probably stay high for the next couple of weeks or months, and once it turns, I can get out. Or I'd rather say, screw market sentiment, I'm going to go straight bottom up. I'm going to look at a company where I think their earnings can grow at a very high rate over the next 5 years, double digits, 15, 20% compounded, and I'd rather stay with that company, no matter where the valuation's at. So that's where you can create your edge using the time horizon. That's something that's very unique, not talked about very much, but it's something that you can use, and you have to understand which one you're more comfortable with. Are you more comfortable with short-term gyrations, or are you just going to stay with the long-term and really hope the fundamentals work out? That's what I have for you today. Use your investment horizon as your edge. Think differently than the market. Don't be a 1 to 2 year investor. If you're going to project those financials, project them out 5, 10 years. Or if you're going to go the other route, maybe you're going to use momentum, or maybe an earnings release or catalyst driven. Find out what's driving that market sentiment and see how long it can last. Do your homework. So that's what I have for you today. So in summary, less than 6 months, greater than 3 years, that's what you should focus on. Until the next time, peace.